Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the fancy financial jargon that companies use. And sometimes it is not just fancy jargon, it is a whole new level of financial mumbo jumbo. Today we're digging into a filing from Urban Edge Properties. This report talks about some big changes in their borrowing agreements. And it is actually pretty interesting because it shows how they're planning to fund their operations and growth. Before we dive in, if you like getting straight to the point with company filings, make sure you are subscribed. Also, we've got a growing Discord community where we break down these reports and talk stocks. The link is in the description below, so come join us. Okay, let's get started. Urban Edge Properties and its operating partnership, Urban Edge Properties LP, have just updated their credit agreements. Think of this like a company getting a new or improved way to borrow money, which is super important for any business that wants to grow or just keep the lights on. So, what they've done is enter into what is called a second amended and restated credit agreement. That is a mouthful, but basically it means they've taken their old loan agreements, updated them, and put them all together in one big new deal. This is happening on the 22nd of January 2026. One of the key things they've changed is their revolving credit facility. Imagine this as a credit card for businesses. They used to have access to $800 million, but now they've reduced that to $700 million. Now, that might sound like they have less money, but it is also important to look at why and what else is happening. They've also pushed out the expiration date for this credit line from early 2027 to mid-2030, with options to extend it even further. This gives them more stability and time to plan. But here is where it gets more interesting. They've also added a completely new loan called a 5-year term facility for $125 million. This is like a specific loan that needs to be paid back over 5 years. It has a neat feature called a delayed draw, which means they don't have to take all the money at once. They can take it out over the first year as they need it. And get this, the whole agreement has what they call an accordion feature. This is super cool. It means that under the revolving credit facility, they can actually expand the total amount they can borrow up to $1.025 billion. So, while the initial amount might have decreased, their potential borrowing power has increased significantly. This gives them a lot of flexibility. What can they use this borrowed money for? Well, pretty much everything a growing company needs. It is for developing new properties, buying new ones, covering their everyday operational costs, making investments, and paying off other debts. It is essentially a flexible fund for all their business needs. And importantly, they haven't actually borrowed anything yet. Now, like any loan agreement, there are rules and limits called covenants. They have to keep their total debt as a percentage of their total capital below 60%. This is a common way lenders manage risk. They've also got rules about how much they earn compared to their interest payments. The key ratios here are designed to make sure they are not taking on too much risk and that they can comfortably handle their debt obligations. If they mess up on these, there can be consequences. It is also important to note that these loans are senior unsecured obligations. This means if the company were to go bankrupt, these lenders would be among the first to get paid back, but they don't have any specific assets tied to the loan as collateral. The operating partnership could also get guarantees from some of its subsidiary companies. But the parent company itself, Urban Edge Properties, is not directly guaranteeing these loans. When it comes to interest rates, they have a choice. They can either use a rate tied to the secured overnight financing rate or SOFR, or a base rate. The interest rate margin, which is the extra percentage they pay on top of the base rate, depends on their debt to capital ratio, or even their credit rating if they choose to go that route. Right now, the rate for SOFR loans is 1.00% for revolving credit and 1.15% for term loans. They also pay a facility fee on the unused portion of the revolving credit facility, which is currently 0.15%. Here is a really modern twist. These interest rates and margins can actually be adjusted up or down based on whether they meet certain environmental, social, and governance or ESG targets. This shows companies are increasingly linking their financing costs to their performance on these important areas. On the same day, the 22nd of January 2026, they also entered into a separate term loan agreement, this time for a 7-year term facility. This is another specific loan for $125 million, but this one lasts for 7 years, maturing in January 2033. It also has that flexible delayed draw feature and an accordion feature that could allow them to increase this loan to $250 million. Pretty much all the terms are similar to the 5-year term facility, except for the duration and the interest rates. The interest rates for this 7-year term facility range from 1.50% to 2.20% per annum for SOFR loans, depending on their debt to capital ratio. The currently applicable margin is 1.50%. One key difference here is that this facility comes with a prepayment premium. They'll pay 2% if they pay it off within the first year, 1% if within the second year, and then nothing after that. This is a common way lenders get compensated if a company pays back a loan early. This whole update was also announced via a press release. Typically, these releases are meant to put a positive spin on things, so it is always good to compare what they say with the actual details in the filing. So, what is the big picture here? Urban Edge Properties is clearly working on strengthening its financial foundation. They're refinancing and extending their credit lines, which gives them more breathing room and flexibility. Reducing the revolving credit line might seem concerning on the surface, but the addition of the new term facilities, along with the potential to increase borrowing capacity through the accordion features, suggests a strategic move towards more structured and longer-term financing. This is often a sign of confidence in their future projects and a desire to secure funding at potentially favourable terms. The fact that they're linking borrowing costs to ESG targets is also a significant trend to watch. It shows a commitment to sustainability and responsible business practices, which can be attractive to investors and good for long-term reputation. Overall, Urban Edge Properties appears to be actively managing its debt and financing to support its business objectives. The new agreements provide ample liquidity and flexibility, which are crucial in the real estate sector. The risks, as always with borrowing, lie in their ability to manage the debt effectively and meet the covenants. But based on this filing, they're taking steps to ensure they have the financial tools they need to operate and grow. Alright, that is our breakdown of Urban Edge Properties' latest financing update. What is your take on these new credit agreements and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate finance. Don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.